Hello, and welcome to the 2017 September version of the PFS video. This month, we will be focusing our attention upon the economy and the impact of rising interest rates. First, real gross domestic product increased at an annualized rate of 3.1% in the third estimate released by the Bureau of Economic Analysis. Economic growth in the second quarter was stronger than previously thought, and this annualized growth rate of 3.1% was the fastest rate since the first quarter of 2015. The boost to growth came from stronger than expected consumer spending, which is usually the biggest contributor to the economy. Personal consumption growth was maintained from the second estimate at a 3.3% rate, led by spending on housing, utilities, prescription drugs, and cell phone services. The 3.1% annualized growth rate is ahead of President Donald Trump's stated 3% target for the economy. But that pace would need to be sustained or surpassed in the third and fourth quarters for there to be 3% growth on an annualized basis. Most economists think low productivity growth could keep economic growth below 3% for the entire year of 2017. Economists are looking ahead to the first estimate of third quarter GDP to be released towards the end of October for any impact of the hurricanes that recently slammed the southeastern coast of the U.S. mainland. We'll stay tuned to see what happens there. The increase in real GDP in the second quarter primarily reflected positive contributions from personal finance and personal consumption. These expenditures are key to driving our economy forward. Also, non-residential fixed investment exports, federal government spending, and private inventory expansion in investments were primarily offset by negatives from residential fixed investment and state and local government spending. Imports, which are a reduction or a subtraction in the calculation of GDP, increased in the second quarter of 2017. There's a high probability the Federal Reserve Bank will likely increase rates a quarter point in December. The Fed sees inflation running close enough to its 2% stated target to forge ahead with its rate and balance sheet normalization program. The central bank will first cut security purchases modestly before gradually cutting more, so that interest rates won't really feel the Fed's effective cuts until next year. Long-term interest rates should rise a little bit by the year end 2017, but inflation's flatness combined with ongoing economic and fiscal policy uncertainty should keep rates from rising much. Bond market investors should see tepid inflation because of flat crude oil prices, as well as subsiding price pressure on new and used cars, doctor's visits, and food and clothing. Investors also believe that any bump to economic growth from government fiscal policies will be delayed for the rest of this year. On the other hand, the Fed sees low inflation as temporary and is focused on the falling unemployment rate and other indicators that show a tightening labor market. The Federal Reserve Bank very much wants to stay ahead of any inflation that rising wages may generate, and probably will lift short-term interest rates by 0.25% again in 2017, likely at the December 13th, 2017 economic meeting. The Fed is also expected to increase interest rates 2 times in 2018. According to Janet Yellen, who is the chair of the Federal Reserve Bank, she said that U.S. economic performance has been good, and the American people should feel the steps we have taken to normalize monetary policy are well justified. The Fed also indicated that it would begin to shrink its $4.2 billion bond portfolio selling bonds that were purchased after the 2008 financial crisis to keep interest rates low. Buying bonds tightens up the monetary policy, shrinks outstanding supply in our government and our economy. So, what does this mean to you as an investor? Well, if the Fed does sell bonds, monetary policy is loosening up, leading to higher interest rates and higher yields on bonds. This will help new bond buyers, but it will hurt current investors as their current bonds fall in value. Now, as to the impact of rising rates on U.S. stocks, investors may compare the average dividend yield on a blue chip stock to the average interest rate on a CD or bond coupon payments and their yield, even to treasury bonds, which are short-term guaranteed securities issued by the Treasury Department. Then investors may choose the option that provides the highest rate of return relative to the risk. With higher interest rates, it's possible that investors leave the stock market and move capital to bonds and CDs. This fact alone may cause the stock market to fall. Also, when interest rates are rising, both businesses and consumers may cut back on spending. This can cause earnings to fall and stock prices to drop. As always, we recommend that PFS clients follow their written financial plan. Capital allocated to long-term growth investments such as stocks and real estate are expected to have the highest degree of volatility and need to be left alone during volatile short-term times. Cash reserves and short-term floating rate bonds should experience minimal fluctuations in value. Stay the course with your financial plan as it is written that we built together, as this will help to lessen the emotional impact of the daily news, political dialogue, and even Mother Nature's unexpected and frequently violent attacks on our personal calm. Thank you as always for your trust and confidence in our guidance. Please feel free to call me directly at 847-268-3670 with any questions that you may have. Or, if you are not yet a PFS client, call me to set up your complimentary personal consultation. Now for the required disclosure at the end of each of these monthly economic updates. While we believe the information contained in this article is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or the solicitation for the purchase or sale of any investment security. Please consult with your financial professional, hopefully us at PFS, before making any investment decision. Thank you and have a great month.